start recording. All right, I think we're recording now.
Yeah.
Hello and welcome. It's August session of Macroeconomics Hours. Both Hadi and I are here, and I'll start by quickly going through the macroeconomic indicators. Unemployment rate, as you know, in July has gone up by 0.2%. Which means that we're probably pretty close to the natural rate of unemployment. It's often estimated at 4.4% or so, but again, that's something that's pretty difficult to estimate. And so labor force participation rate has increased tiny bit, even though it's been extremely stable over the last year. And so this means that there is a little more pressure on Fed to change its policy rates. We don't quite know what the inflation looked like in July yet. I think those numbers are going to be released sometime next week, around August 14th. But as a reminder, in June of 24, we looked at about 3% CPI and about 3.3% core CPI. And so we're probably going to have fairly similar numbers, maybe a slight decrease as of July now, which means that since the Fed hasn't changed the rates at the August 24 meeting as expected, when September rolls in and their next meeting is around September 18th, the markets are sort of split in their expectations. And, about half of the market participants are now expecting a decrease of 25 basis points. Half of them expect that it's going to be a little more aggressive at 50 basis points. But if you're continuing on this trajectory, then the exchange rates are probably going to continue. The interest rates are probably going to continue going down, right? So that's what we have for the macroeconomic indicators update. And so one of the things that I wanted to talk about is the update on exchange rates, again connected to the latest results of the Big Mac index. So the Big Mac index is follows a very simple idea. If we take this uniform product that is sold in different countries, such as Big Mac, and Big Mac, in a sense, it's a bit of a basket of goods because it incorporates some local ingredients, it incorporates potentially some imported ingredients, local labor, local rent, so on and so forth. But the general idea is that the value of currency should be reflective of its purchasing power. That's what we know as the purchasing power parity. If a Big Mac costs $5 in the US and it costs $6 in Canada, then what we expect to see as the exchange rate between Canadian dollar and US dollar is about 1.2%, or 1.2 Canadian dollars for US dollar, right? And so if the rate is higher than 1.2, then US dollars overvalued and Canadian dollars overvalued. If it's less than 1.2, then US dollars undervalued and Canadian dollars overvalued. And you can also take, you can also adjust that raw index that only looks at the prices by GDP per capita, right? Essentially, when they look at Big Macs, they, it's an equivalent of a small basket of goods. It incorporates some non-tradable components such as labor and rent, right? They tend to be higher in richer countries. And so if they make this adjustment, then we have a slightly different approach to measuring those exchange rates, right? And we can look either at the raw index or the GDP adjusted index in here, right? And so if we look at the results from 2024, from June of 2024, so roughly a month ago, what we're seeing is that US dollar compared to most of the countries that had been measured still is pretty, sorry, I have a typo in here. So what I meant to say is that sorry about that, is that US dollar is overvalued compared to most currency. That's is overvalued compared to most currencies, right? And there is a handful of countries that seem to be overvalued by either measure. For example, British pound is one of them. The euro is one of them. Swiss franc is also one of them as well. But still, the dollar tends to be a little more expensive in terms of ergonomics. And so that's actually it for me. I think I ran through everything in like under 5 minutes, Hadi. So, any questions or thoughts on the macroeconomic indicators, on the exchange rates, anything from the field? All right, folks are pretty quiet. Um, Hadi, go ahead. Hadi, you might be on mute.
Yes, I was muted. So let me share my screen. Okay. Now, what we want to do today is first, there was the exchange rate issue that Vlad reviewed. And then what I would like to do is to look at the situation with the stock market. And the key question I want to answer is whether we should be buying or selling stocks, what to expect in the coming weeks and months. So there are two articles in this week's The Economist which that are relevant. So I have the links here, which we will share on LinkedIn. So the stocks fell last week very sharply. And one is wondering whether this was a one-off thing that was by mistake going down, or is it something that is the sign of future drops in the stock market? Something is not working and it will continue to decline or stay low for a while. So should we be buying or selling stocks these days? Was this simply last week's experience a madness on part of some investors who sold too low, or did they know something and expect something that caused them to sell at a lower rate last week? And was not just the US, the global markets experienced a decline, led by the US, of course, but the Japanese market topics is an index of Japanese market went down even further than US market last week. And they have recovered after that to some extent. But still the question is there, what to expect and what do we know about volatility, the chances of further sharp declines. Now, if we look at the volatility index, which measures the extent to which investors expect the prices to drop or rise, swing around, it's jumped up. And what is really notable is that if you look at the volatility index since 2008, this is the third highest volatility index. Or in fact, it's very similar to what happened at the beginning of the COVID crisis here, and just a little bit less than the financial crisis of about 15, 16 years.
Sorry, folks. Did we lose Hadi, or is it just me?
You froze for me too.
Okay, so hopefully he's gonna be back. He's gonna be back very soon. Um, Hadi, you're back. You're on mute again.
I guess I don't know what happened. What was Was my image gone for a while?
It was frozen, so for about a minute or so, I
I'm
would
really
say.
sorry. So
No worries.
let me go back to, is this share the screen? The share screen is not there, right? So I need to share my screen again. Sorry about that. Okay. Let me go back to, I guess this was the part that I was talking about and may have missed, right?
Yeah, that's right. That's right.
So we've had very high volatility last week, amazingly high, comparable to what happened at the beginning of COVID and beginning of, or middle of financial crisis of 16 years ago. So was significant. And the question is whether we should be agreeing with people who think the stocks are overvalued and they're going to drop in the coming months, or should we be agreeing with those who think that the high valuation of stocks is not a problem and
Oh, did we lose Hadi again? It's been one
I
of
think
those days,
so.
right? Okay, sorry, all.
No worries.
The internet, I guess, is not cooperating. I've had days like this. Hopefully, at least thankfully, not when we had a lot of live lectures. That I was doing from home.
No, don't
Uh,
need to apologize, Vlad. It has been very nice of you to do
yeah.
this for us already, so no worries at all. And congratulations to your new house.
Oh,
Looks
thanks
nice.
very much. Yeah, I'm excited, but sort of I don't know if it's congratulations or condolences, right now because it's just all over. Hadi, you're back.
Maybe Professor Hadi can switch off the video. It might help us on the bandwidth.
Oh, turn off my video.
Maybe that might help
Okay,
because it is a
let me
topic.
do that. That's a very good suggestion. I don't
Yeah.
know what's going on with my computer. I think there's something wrong with my computer that keeps dropping the connection with the Wi-Fi.
Mm.
Let me check my Wi-Fi connection.
But maybe you wanted to come back, reconnect.
Okay, so I'll do that. Let me get out and then come back. I'll be back in a second.
Okay,
Take your
sounds
time.
good.
Thank you.
Thank you, Hadi.
I was about to comment on the Big Mac index. Recently, I read an article about the Typhoon, the soup dumpling index, because there's it is a very well-known brand in Taiwan doing soup dumplings, and they have shops everywhere. And the new one is opening in New York, at New York City. So they actually trying to figure it out, like same amount of money, how many dumplings that you can buy.
Yeah, that's right. That's right. Well, sort of, I think if you look at Taiwan's performance on the Big Mac index, Taiwanese currency is quite undervalued, right? So generally speaking, quite much higher purchasing power. So I would imagine it would probably be very similar results, especially if what they're looking at is not just, the franchise prices all over the country, but New York, where things do tend to be a lot more expensive, right?
Interesting. I didn't think about that.
Yeah. All right, Hadi, you're on mute. If you want to unmute yourself and Hadi, you're still on mute.
Okay.
All right.
Very sorry, folks. I don't know what's happening to. I tried to connect to another a different Wi-Fi, so hopefully this will work.
No need to apologize, Professor. Thank you so much for doing this.
Sure. Thank you. Thanks for your kindness. Okay, so the issue, I think I already have conveyed this message that we want to know what to expect. So let me go to the next slide. Now, why did the stocks fall? The first problem was Trump. He said that Taiwan needs to pay for its own defense, and that means that a big chunk of the semiconductor industry has to basically take care of itself, and US market might be affected by what's happening between Taiwan and China, rather than US taking responsibility for defense of Taiwan and trying to assure everybody that Taiwan is going to be okay, and the flow of high-end semiconductor equipment and chips, etc., is not going to be in danger. So that was one factor. And on top of that, Biden's administration also is considering some curbs on exports of chip making equipment to China. That reduces the profits of chip makers and therefore and some other companies, and that is a problem that has affected the high tech end of the market. Meanwhile, companies that rely on artificial intelligence and have been doing very well on the expectation that this technological change will bring profits and benefits to the market. It seems that some investors expect AI not to provide as much as profit as much as previously expected. So that end of the market, the high tech, fell much more sharply than the average. There's also a little bit of weakness in US job market. The unemployment rate went up a little bit, and the new jobs created was lower than expected. And that last week, because of that, investors started thinking that maybe we're entering a recession. So if you look at, for example, from April 2023 to July 2024, unemployment went up by about 0.9%, close to 1%. And historically, when such a thing happens, usually you see the beginning of a recession, but very unlikely in this situation. This time it may be different. Still, unemployment rate 4.3% is pretty low compared to historical records. So it may be a sign of a problem to come, maybe not. Here's the rate of unemployment from 2019 till lately. We experienced a very high unemployment rate in 2020 because of COVID, but lately unemployment rate went down in 2022 and has been gradually going up. And this is not a problem. In fact, the Fed has been doing this intentionally to slow down inflation. And if inflation continues to decline, we should be okay. We should experience what is known as soft landing. Now, because of the expectation that the economy is slowing down and inflation is slowing down, the expectation is that, as Vlad pointed out earlier, the expectation is that the Fed will cut interest rates in its September meeting. And already the markets are looking forward to a decline in interest rates in the future, and long-term interest rates are dropping. So treasury yields are dropping. In fact, they dropped by a full percentage point in the past several months. So that has weakened the US dollar vis-a-vis Japanese yen and some other currencies. At the same time, Japan, surprisingly, Bank of Japan increased interest rates from negative territory to positive territory about 0.25%, which it hadn't done that for years. And this basically signaled that yen may be strengthening, and it may have contributed to the volatility in US and some international markets. As you can see here, there was a very sharp rise in the value of yen in the market as a result of weakening, lowering of long-term interest rates in the US and the rise in interest rates in Japan. Of course, the changes that we see in the interest rates are not that much, especially for Japan itself, but the reaction was pretty strong, and that has some implications. We need to understand why the yen rise so much, because it caused a major drop in stocks in Tokyo and also may have affected the US as well. The reason the stock market in Tokyo fell as a result of rising yen is that Japanese exporters are going to have trouble making profits with the strong yen, and as a result, their profits are going to go down. And therefore, the stocks dropped. The impact for the US is that if there's a recession in Japan, it might affect indirectly the US market as well. So strengthening of the yen was another factor that may have contributed to volatility, and it also tells us something a little bit more. In order to understand why the reaction to change in interest rates was so strong on the yen, you need to know that one of the phenomena around the yen is what is known as carry trade. What is carry trade? Interest rates were practically zero in Japan, so a lot of borrowers were borrowing there, taking the money out of Japan and investing in the US and other high-yielding, high-interest rate economies. Not necessarily buying bonds. They may have borrowed in yen to buy AI stocks in the US, for example, or generally stocks in the US. Now, if interest rates go up in Japan, that causes difficulty for people who have borrowed in yen. They're now earning dollars, but dollars are losing value relative to yen, so they may not be able to pay back their debt. And since a lot of people have done this, a lot of companies have engaged in this kind of trade, carry trade, suddenly a lot of companies shifting from dollars to yen could cause the value of yen to go up, and that prompts other companies that have been doing the same to try to jump in and buy as much yen as they can in order to be able to pay back their debts in Japanese yen. And that may have exacerbated the problem that Japanese yen jumped up so sharply. It's not necessarily the small increase in interest rates in Japan, it's the anticipation that others may be doing the same thing, and everybody wants to buy yen at the same time, and therefore everybody tries to get ahead of the queue. So this says that the stock market rout may not be over. Too many financial companies seem to, especially hedge funds, seem to have borrowed to buy technology stocks, especially AI-related stocks. And if AI doesn't do very well, they will not be able to pay back their debts. And we're going to see major volatility in the exchange rates and stock market. If market declines and a lot of financial companies counter asset and liability imbalances, their assets go down in value and liabilities remain the same or maybe even go up in foreign currency, in Japanese yen, for example, then they're going to try to liquidate their assets, and that liquidation could drive down the stock market in the US even further. if especially this is going to be a major drop cause a major drop in U.S. stocks. If some companies, larger companies, especially financial companies, hedge funds, if they're forced to sell their technology-related stocks in order to meet their debt obligations in yen, for example, or in other low interest or places that used to be low interest economies, those who have borrowed in those other currencies may have difficulty meeting their obligations, their debt obligations. And as a result, we're going to see a further drop in the value of the dollar, a rise in the value of yen, and maybe some bankruptcies, maybe further decline in U.S. stocks. In fact, this could turn into a meltdown in stock market in the U.S. This is all just possibility. This is not necessarily what's going to happen, but these are concerns that remain. So there's also, on top of this, the problem that valuation of U.S. stocks seems to be quite high. PE ratios are historically very high in the U.S. Unless you're going to see a major increase in profits, in earnings over the next several months, we may have actually trouble maintaining these kinds of PE ratios. And what is interesting is that it seems that there's been a lot of borrowing and betting under the assumption that interest rates will go down and earnings will grow fast. And if that scenario does not materialize, the stock markets are going to be in trouble. The problem also is that the U.S. government is pretty overextended because they have borrowed heavily over the past several years to deal with the COVID crisis, to deal with other crises that were from the past since the financial crisis of 2008, and therefore the U.S. government may not be in a position to fight off a decline in the stock market and decline in the economy. The Fed might be in a better position, but still it seems a bit overextended because its balance sheet is pretty large right now. They had created tons of money in the past, and they're trying to collect that money back. And if the economy heads towards a recession, then they may not be in a good position to again stimulate the economy the way they did in the past couple of crises. So shocks to the economy in this volatile situation could cause a major decline in the markets very intensely and very broadly. And that could lead to a beginning of a recession, because if stocks go down, people are going to be careful spending money. They're going to see their wealth go down and therefore cut back on their expenditure and consumption expenditure. That could lead to cut back in investment by companies, and unemployment may continue to rise, and that therefore we might see a major drop in overall demand and enter a recession. Of course, when you look at other countries, it's hard to see the beginning of a recession overall in the world economy. U.S. economy seems to be a bit more overextended and exposed to risks, but other countries don't seem to be quite in the same situation. Unemployment has risen, but only slightly. OECD, the club of rich countries, is experiencing rising labor force participation and relatively low unemployment. So total employment has risen. Inflation is declining in all countries. So these are the positive sides. And so far, all the signs of vitality of economies, companies, seems to be overall pretty good. There's a current activity indicator that Goldman Sachs produces based on high-frequency data. So very regularly, that can be updated. One doesn't have to wait for GDP data to come out. And this seems to have been doing pretty well in the last year or so. This is the graph of that index. And it seems that if you compare this year with the previous year, you see it's doing relative to the 0.0, which is indifference. It's in the positive territory and even higher than what it was last year. So overall, global economy seems to be in reasonably good shape. So in the second article that I had posted on from The Economist, The Economist argues that a global recession is not in prospect. Some concerns remain, of course. Inflation has not yet been defeated. Expectations of a recession can become self-fulfilling. People think there's going to be a recession. They're not going to put their money in the stock market. The stock market goes down, wealth goes down, and consumption goes down, etc. And then investment is going to be reduced, and we're going to enter a recession because of self-fulfilling prophecies of or expectations of a recession. But at this point, interest rates tend to be high, which is slowing down the economies. But at the same time, in my view, the high interest rates are good news in some sense, because they say that if in case there's a movement towards a recession, that recessionary tendencies, the Fed could actually has room to lower interest rates and keep the economy afloat. So overall, on the positive side for the market, things seem to be relatively healthy and in good shape. Now, I would like to hear from you folks. What do you think? Should we expect further trouble in the coming months, given all the information that we have, or should we be still relatively confident that the economy could continue growing at a decent rate, not necessarily super rate, but a decent rate in the coming months? And that means that the stocks, incomes, unemployment, etc., should move towards a long-run equilibrium, which is we call soft landing. All right, so that's my presentation, and I would like to hear your thoughts and comments.
So let me ask you a question, Hadi, if I could.
Sure.
How concerned are you about stock market overvaluation in the United States? If you look at the PE ratios, they certainly seem much higher than the long-term average. I think long-term average was somewhere around 1920, right? And even that is heavily influenced by the last 20 years or so. And so what we're looking at right now is somewhere that's getting closer to 30, right? Sort of about 30 to 50% higher than the historical average has been. Is that a cause for concern for you? And how much concern is that?
It is cause for concern for me. I think market is a bit overextended, and it's vulnerable to shocks. And that's we saw the example last week. So I hope what will happen is, in the best scenario from my perspective, is that stocks do not rise that much in the coming months, but earnings rise. So P ratio adjusts that way, rather than P ratios adjusting by the value of the stocks, the price is going down.
All
But
right.
that's not a sort of far-fetched scenario. Either one could happen. Probably the decline in prices may be in order in the coming months. So do not be surprised if we see some correction in the market.
Hopefully it's not too much of a correction.
Right.
And hopefully, sort of some of the pressure in there will be taken away by the increase in the earnings ratios.
Right.
But again, to increase the earnings ratios, I mean, this means that very often companies start cutting costs if they're unable to grow revenue, and if you start cutting costs, that starts contributing to unemployment, right? And that can set off a reaction in its own way, right? Many companies have been spending like crazy, especially in the area of AI. AI is one of those general purpose technologies that I think is still has quite a bit to go before it really starts getting reflected in the productivity metrics. So there is a number of dangerous points that we're looking at.
Exactly.
Mm-hmm.
So let's hear from our friends in the meeting. Anybody wants to tell us what they think? Which way should I be buying stocks or selling or staying out of the market?
And how are things looking in your industry too?
Oh yes, and I guess a lot of our constituency here are in tech industry, right?
That's correct, right, Vivian?
Oh, hi, Professor. I can share a little bit my own observation.
Sure.
Thank you both for sharing the article. It's my first time reading about the Big Mac index, which is kind of interesting. I think one of the interesting factor they also pointed out is for the AI boom. They feel they did not meet the initial expectation. So from my personal observation, in early June, a couple of my family friends and just people I know start to ask, oh, should we buy NVIDIA? Then I feel like that's almost an indicator showing the stock has reached the maximum potential in the short term. But with that said, I do feel like if that further goes down for me, I feel in long term, it will still play out in a very good return. So I will still invest that, but I do see AI stock to going down in the short term just because the initial investment is too large. And for the industry I'm in the commercial real estate industry. So that has been heavily affected by the high interest Fed has in the last couple years. And right now, even just look at the hotel sector, there are 5.8 billion loans that's gonna expire by end of this year. So if they don't have the lower interest rate, that could have a major factor play into how can those property being refinanced in a reasonable rate. So that could cause a lot of commercial real estate being auctioned or sell. So that's just from my perspective.
Thank you for sharing your thoughts.
Great
wonderful.
Observations. I wanted to mention that NVIDIA, interestingly, this is one of those companies that had benefited quite a bit from the AI frenzy, right? Sort of when they see companies investing in AI, for them the return might be uncertain. For NVIDIA, however, which sells the equipment required for AI investments, for them the investment, their return on investment had been pretty immediate, right? Which is what made it into a very hot stock. But looking into the future, if AI investment starts going down, so so will sales for NVIDIA too.
Thank you. Sorry, I couldn't find the unmute button for some reason. Something is wrong with my iPhone. Sorry about that. Yeah, I totally agree with what just the discussion was about. And regarding tech, there's so much talk about AI and maybe it's being overinvested. So it's like so much money pumped into the industry. It's like hundreds and billion of dollars. It's crazy. But if you look at all these tech companies, they actually promise to do even more. So maybe we're just seeing the tip of the iceberg at this moment. But then there are people also saying that it's very hard to see the result of all these investments how we're gonna monetize the entire AI investment. But people also say that maybe we're just getting, in the beginning of the infrastructure building. So as we go more, and then we will finally see the result. So I mean, honestly, I'm still very confused about all these different discussions. Sometimes the conflicting thoughts and observations and things like that. So what I eventually kind of settle in is, as a personal investor, I also want to make sure that I have my downside, everything that is being protected. I'm not going to lose my house tomorrow, things like that. Congratulations to Vlad. He's finally becoming one of us. So we're going to see how he reacts to interest rate. He used to be on the sideline, cheering us on. So maybe now he can really feel our pain sometimes. Yeah. So, and then, just very consistent that kind of investment approach. But and I want to comment on the real estate a little bit, because I think that is a very different asset class. It's very, very interest sensitive, because people folks over there really, really leverage their entire chain. Is not just from buying the land that really borrow a lot of money, all the way to management and everything. So that is very interest rate sensitive. I would really want to see how things are going to play out in that sector. Sorry about it was a long.
No worries.
Very
no
good
worries.
thoughts. Very interesting. I'm glad you brought up the issue of real estate. That is a part of the market that has been stagnating, and the market is basically very weak. But what I see is that it's picking up. If interest rates go down another half percentage point or 1%, I think we're going to see a lot more activity. So the economy could easily be saved by bringing back the housing market, or revitalizing the housing market by cutting down long-term interest rates by about a percentage point.
And there is a good chance that we might get half the way there in September, right?
Right.
Yeah. And if the rate is coming down, then that means the treasury, the government doesn't have to pay that much interest, at least a little bit less than before. So maybe that physical crisis or concern will come down a little bit more. I don't know.
Exactly. Good thoughts. Very good point.
I can raise one point. I think I'm also thinking, like, with interest rates potentially going down, even though the large companies or large tech might get affected slightly, but the small stocks can sort of start swinging back up, especially with the lower interest rates. They've been kind of waiting for those investments or those equity loans. I think they could benefit from the lower interest rates as well.
That's a good point. Switching from large tech firms into small ones, and I guess small companies have not been doing very well, or stocks of smaller companies have not been doing very well in the past 6 months, right? But now we could see actually some pickup on that part of the market.
Just to add to it, actually, Professor, thank you for doing the session today. Both of you taking the time out. I'm in the semiconductor industry, so the observation that we are seeing is a little slowdown as such in the in the industry as such. But in the long run, the way the AI growth is going to potentially be incorporated, there is always a dipping point to buy stuff, and to me, I think it is a good option to buy stocks when they're dipping it out. And the last opportunity was a good one. It happened. Overall, in a long term, unless there is a larger macroeconomic disturbance in Taiwan, things should be fine.
Very good point. Hopefully, Trump will not be elected. Otherwise, he's going to give TMC to China.
Oh no.
So Professor,
I'm also not. Yeah, go ahead. I'll go after you.
to expand on that, so what do you think the result of the presidential election is going to have effect on market? What's your thought?
Let me go first. I think the market is not going to be affected all that much, even though one thinks that there may be, but economic policies might not change dramatically or drastically, whether it's Trump or Kamala Harris. They both seem to be opposing trade with China or will be restricting trade with China. I think it's bipartisan in that sense. In terms of expenditure, both of them are going to continue to keep public government expenditure relatively high. So the deficit is going to continue to be there, very problematic for the economy. The only concern I have is that the Fed might lose its independence under Trump administration. If that happens, that is going to be very destabilizing for the U.S. economy.
Yeah, I was about to ask that. Maybe Jerome Powell will have to find a new job.
Say it again. I didn't catch you.
Yeah, that's a very good point. I was just reading something about that the other day. So maybe Jerome Powell will have to go find a new job if it...
That's what Trump says.
Yep.
But of course, right now he doesn't have all that much power to remove Powell. But gradually, if he becomes president, he could change the rules and laws or stuff, putting pressure on the Fed and make life miserable for them. And that could lead to some deterioration in the situation of the Fed.
Yeah. I actually have some observations recently regarding unions. I think in the classes you guys have been talking about how unions or minimum wage will create a lot of dead weight in terms of the productivity and all that kind of thing, right? But then yet it's being a very welcome policy, and we all understand how the working populations having problems even making their living minimum wage. So how do you square these two different perspectives and approaches?
To minimum wage rise?
Yeah.
My line on this is that as long as the increase in minimum wage is not too much, we're not going to see negative effects. In fact, we might see some positive effects from better distribution of income and demand generated from the lower end of the income spectrum. So that could counter the problem of companies not wanting to hire people at higher cost. They're going to see also with the rising minimum wage, they're going to see the demand rise. So this is going to be balanced out to some extent. But if the hike in minimum wage continues, there is a point where it might be too much and might actually trigger higher unemployment and major problems for the economy.
I think we're still in kind of this ultimate laboratory of what increases minimum wage will result in, right? Because for many years, when we look at what we've taught to students in the introductory economics classes in Econ 101 and 102, was this very classical model as higher minimum wage creating unemployment, right? And so the research that's been coming out in the last 10 years, again, it all looks at the short run. It looks, sort of, it kind of, there is some high quality research kind of that combines, a control group and the, test group, when they look at the, changes in employment in geographic areas that are very close to each other when one of the states increases the minimum wage, but the other one doesn't, right? And so far, it does look like companies have not responded too much by decreasing their employment, sort of when minimum wage increases. But again, all of this research is kind of short-run research, right? We don't quite know what it's going to look like in the long run because, short run and long run are very fickle in economics, right? We'll have to see how it will impact the state. I mean, so far it looks like most states and most, municipalities are taking the approach of not making huge increases right away. They'll take the approach of saying, okay, we're going to increase it by $1 this year, by $1 the next year, so on and so forth, until it rises to some point, and then we're going to stop at that point. And that's been a pretty decent approach, right? I mean, again, if you also look at it from the perspective of what it will do to government spending in some cases, there's been a real concern that, in the past, if you go to one of those employers that had been famous for, paying the minimum wage to their workers, and Walmart used to be one of the examples of that, right? There have been studies that looked at kind of a cost of this policy to the government, because a lot of those employees, they were eligible for some sort of government assistance, right? Because, you might be eligible for food stamps, you might be eligible for other types of assistance. And in some ways, sort of the benefit is accrued by the employer, but some of the costs are pushed onto the population in general through the form of those government subsidies and government payments. And as that kind of goes away as the wages rise, sort of that kind of forces the company to, internalize the cost of their own employees, right? They no longer create an externality for everybody else. And, this is going to be an interesting set of effects. And I think there's probably going to be some research coming out in the next couple of years that looks at it too.
Got it. That's very interesting. Thank you.
Okay. Other thoughts and comments?
I'm also thinking like Warren Buffett's exit from Apple and Bank of America, like could that have also triggered some of the retail investors to sell off, in addition to some of the factors that we were talking about?
Very good point. Good question. I was surprised by Buffett's move.
Yeah. Did we lose your sound, or is it just me?
No, I just.
All right.
I just said that it was a surprise, and I don't know what to make of it. I don't think Apple is going to go down the drain now that Buffett has sold his stakes.
And neither will the Bank of America, right? I mean, Bank of America probably is not a happy camper as the Fed is increasing, sort of the equity requirements for very large banks. So the playing field for large systemically important banks is going to be different from the playing field for smaller banks. It's going to be interesting to see how it comes out, right? But generally speaking, sort of as financial industry changes, as shadow banks and shadow financial providers kind of even the playing field for everybody else, it's probably going to be a little costly to be one of those very large systemically important banks in terms of the cost of doing business compared to everyone else. We'll see how this cookie crumbles.
Buffett is keeping his Wells Fargo investment, right?
Seriously? Wow. Wonder what the rationale is for keeping Wells Fargo.
It's hard to tell. Sometimes I wonder to what extent Buffett just keeps getting lucky.
Well,
we need some
or
of that
at the very same time,
who keeps getting lucky.
Well, I think, also by the very virtue of Buffett making stances on those sorts of things, he impacts, he influences other investors, right? And, sort of that kind of helps if that luck, because it becomes a self-fulfilling prophecy. Because if Buffett is doing that, that must be the right thing to do.
That's true.
And he had also compiled a huge position of cash or treasuries. He definitely has invested them in money market or something, but in excess of $180 billion cash. That is amazing.
And that got to be some kind of GDP of some smaller countries out there.
Right. So I think part of my sort of Buffett's strategy is to have a lot of cash to be able to buy companies that are in trouble or temporarily lose value. That's part of what he does. It's not necessarily investing in the market like retail investors do to just take the prices given. He actually bargains to buy these things at much lower prices.
And from that perspective, that probably explains the Wells Fargo phenomenon, right? Wells Fargo had been a very troubled financial institution. Its stock market price had been beaten down by scandal after scandal after scandal, and by some of the highest fines that they ended up paying to financial regulators. As a result of that scandal, where Wells Fargo was opening fake accounts for people based on its absolutely insane policies for cross-selling. And, if it's not doing great, sort of that probably has a lot more potential to appreciate in the future compared to a relatively well-run institution like Bank of America, which doesn't have any scandals, sort of which does well on the stress tests, and which in general is probably in a point where it's very, very stable and there is not much room for going up or going down, right?
Got it. Makes sense. So look forward to hearing about the next interest rate movement. But I've heard that has been built into the market already, priced into the market that much already. So I think if the Fed is not doing anything in September, that will cause some problem.
Oh yes, that's a very good point. So in a sense, the Fed now has to cut interest rates, otherwise the market is going to go nosedive.
Now the question is how much? It's like 25 or 50, right? So we'll see.
Right now, the markets are kind of split halfway, right? Sort of it's about 50% expect 25 basis point cut, 50% expect 50 basis point cut. So, we'll see how that cookie crumbles. Again, it's going to depend on what sort of news are going to come out between now and September 18th.
So next time when we meet in September, it's going to be just before the Fed makes a move. And maybe we should take some bets and
Heidi, what do you think? Is it going to be 25 basis point, 50, something else?
25.
I was thinking 25 too. I think 50 is a bit too much. That will send the wrong signal.
In fact, if I were making the Fed's policy, I would not cut the interest rates for now until I am sure inflation is moving towards 2%. But the Fed, as you pointed out, may have to cut anyway, because otherwise we're going to be triggering a recession in the economy.
But they were said to be too slow to raise the interest rate or something like that. And so I think that they might want it to err on the safe side and just want to cut it right away. I don't know. I'm just kind of curious about that too. We'll see.
We'll see.
No, I think you're right about that, right? Because, the Fed lost a lot of its credibility, and this is the main asset for a central banker, its credibility, so that the markets believe what the Fed says it will do, what the central bank says it will do. And so in trying to restore the credibility, I think it has a bit of an incentive to decrease the rate slower than it normally would. So there is some bias on that side for sure.
Well, okay. Let's bet on that. Then we will see that next time.
Okay, so Heidi and Vivian are saying 25 basis points cut.
Right.
I'm going to say 50 basis points cut just to keep it interesting, and we'll see how it rolls out on September 18th.
We need to bet on some money to make it more fun.
I'm joining Team God on that one.
We have crypto to bet on.
All right, very good.
Okay, cool. Cool. Thank you guys
folks.
so much. Thank you.
Thank you all.
Thanks for joining us.
Thank you.
If you have any ideas for the future, please share them with us. We'll be happy to, structure the future coverage accordingly.
Mm-hmm.
Thank you all.
Have a
Thank
good
you.
weekend.
Bye.
Bye.
Bye for now.